Bismillahirrahmanirrahim. Dear students, we will continue the lecture we were discussing in the previous week, that was acquisition valuation, and this is actually a chapter from the Damodaran's book, Corporate Finance. So we were discussing the different steps in the acquisition process or valuation process. The first step is that we have to determine the motive for our acquisition. In that, first of all, we have to determine the target firm, the firm which we want to acquire. And there are certain conditions, like if you want to acquire a firm which is currently undervalued, so you have to consider certain things. Secondly, in the same step, we have to see that we want to diversify risk, because if we indulge in different kinds of business or in different line of products on different market, we will be in a position to diversify the whole risk. So that might be the motive for our acquisition. And the third one was that we want to see that whether after the acquisition and after the whole transition, whether the company is gaining financial or operational synergy or not. So we will continue the same thing, that is the operational and financial synergy, that how these can be helpful, and what are the different empirical evidence regarding these financial and operational synergy, and whether the companies are in a position to gain operational or financial synergy after the acquisition. So there are certain researchers which have done a vast research regarding this aspect. First, we see that in 1993 examined that motive behind almost 77 acquisition in 1885 to 1886 they actually suggest that that operational synergy was a primary motive in third of these takeovers. Many other studies were also examined, and they were examined in order to see that whether the synergy, which we might think that the major enforcing factor behind takeovers and acquisition, so whether the companies are in a position to get that type of synergy which they are planning, and if synergy is perceived to exist in a takeover, what would be the value of a combined firm after the transition has been taken place. So if we look at the equation, that suggests that value of AB should be greater than value of A plus value of B. So where value of AB is value of a firm created by combining A and B, that is actually a targeted synergy firm, and the value of A is equal to value of a firm A operating independently, and value of B is equal to value of the firm B operating independently. That means that if we want to achieve synergy, the value of the combined firm of that is actually AB should be greater than the independent value of A plus independent value of B. So yeah, would be the major synergy, and this would be the major equation we want to achieve while we are planning to achieve synergy. So studies of different stock returns around merger and announcement generally concluded that the value of the combined firm does not increase in most takeovers. That the increase is significant. That means that many firms which have planned that they'll be getting synergy, or they'll be achieving the motive of synergy from acquisition or takeovers. So they might actually conclude that it does increase, and the increase is significant. So another research that was done by Bradley, Desai, and Kim, and they almost examined 236 inter-firms tender offers between 1963 and 1984, and they said the result they provide suggests that the combined value of target and the bidder firm increased 7.8%, that is $117 million in 1884 dollars, 1984 dollars on average on the announcement of the merger. This result has to be interpreted with caution, because both researchers are pointing that after the takeover or after the acquisition, the synergy can be achieved, but it should be seen that there now not only the operational and financial synergy is important. There is another important aspect that is called as control. That if after the merger or acquisition or any tender offer that is completed, that the control management also changes. So, and what is the importance of corporate control uh, in increasing the synergy or increasing the value of the firm? So without considering this thing, this hypothesis cannot be accepted. So in the next step would be that we see that how the control can be helpful, or change in the control would be helpful in increasing the synergy of the firm. Now, the next aspect we will discuss is the valuation of control. And what is the valuation of control? That means that in certain times when many firms who want to pursue growth strategy, and they want to acquire different firms in order to increase their portfolio, or sometimes they want to diversify. But sometimes they think that certain firms which they think are not being properly managed, and if they can acquire those firms and provide their management expertise, and have a major and take a major managerial step or decision in the management of that company, so that will definitely increase the value of that firm. And by amalgamating or taking over at that firm will be helpful for the company. So they look for firms which are very poorly managed, and they remove their incumbent management and change their management practices, policies or practices, and make the firm more valuable, and increasing the value of the firm. But it should be important that when we are doing all those things, there are certain prerequisites before getting the success from that kind of strategy, because a certain time certain things are looking very differently, but actually there are certain other factors which are affecting those situations. So when you are pursuing this strategy, you have to consider certain prerequisite before pursuing your motive for increasing the value through control. So there are majorly three prerequisites. The first requisite is that when you are looking for a poorly management firm, and you find one, and you are going to you want to acquire that firm, so first of all you have to make it clear that poor performance is the result of bad management practices or inefficient management practices of the firm, rather than any other aspect like changes in industry trends or market trends, or any other kind of other kind of aspect which is not under the control of management. So in that case you have to make it clear before that. But if that's the case, that these are the changes, or the poor performance is not due to poor management, but poor other factors which are not under the control of management, so definitely it will not increase the value, because the major the reason behind its poor performance is not the poor management practices. So first of all you have to make it clear. Secondly, the acquisition has to be followed by a change management practice. That means that when you acquire that firm, and you acquire that firm and you want to and the major emphasis was to increase the value through control. So if you acquire that firm, you should change your management practices. And once you change management practices, the second aspect is that change should increase the value. That has an impact on the company, and that impact can easily be reflected through increased in the cash flows from existing assets, or you can say there would be increased in the overall growth rates of the company, like in gross profit, or you can say in the net profit, or any other profitability aspects or liquidity aspect or any other aspect of the company, or increase the length of the growth period, because we see that there are certain growth periods through which companies goes, like just like the business cycles. So when you have a increased growth period, length of the growth period, that would also give you a benefit. And last thing is reduce the cost of capital. That means that when you are taking changes in the management, so it would be reflected in the decrease of your cost of capital, whether it is debt or whether it is that is equity. So it should be decrease cost of capital. The last thing is that the price of the acquisition, when you are going to because there is certain price of that acquisition, so that should reflect the status quo. That means that the price of the current management and their poor management practices. If that price, the premium you want to have from acquiring that firm is already reflected in the in the price, or already emerged in the premium that is built in the price, so the company cannot get premium or earn premium from that. So that means that the price should be status quo. So these should be, the company should consider all these things before pursuing their objective of increasing the value through control. And now we will look into different empirical evidence related to value of control. Various researches have been conducted, and there are actually strong support for the existence of corporate control. And when we look into different researches, so researchers has found certain patterns, like for example, there are certain types of firms in which a hostile takeover has been taken place, and they have performed very well after the takeover. So what are the patterns, and what are the types of the firm which can be higher, which can improve their value after the acquisition due to their change in the control or change in the management, are there are three different types of firm. First are those firms which actually whose stocks, because we are talking about corporate firms, so those firms which whose stock has been performing not well, and they are underperform underperform, and their returns to shareholders are minimal, and so before the takeover had been taken place. Secondly, these firms are less profitable. That means that they are their net income or their gross profit and anything, their expenses are higher, their profits are lower, so they are not being so profitable in the industry. That would be this is the possibility that these firms could perform better after the hostile takeover or any other kind of friendly acquisition, whatever the case might be. Or third one is that those firms whose stock holdings are lower by the insider then do firm in its peer groups. That means that as compared to the other groups, other firms who are working in that industry, so as compared to that, if these firms has a lower stock holding in by their insiders, so that it might be possible that these firms can outperform, and they can perform good after the acquisition have been taken place. Many other researchers have done certain research, and they have found evidence that majority of firms make significant change in the way they operate after the hostile takeover. That means that they make significant changes in their management, significant change in their operations, and many other things in their corporate governance. But there are certain consequences related to hostile takeover which should be considered before pursuing your strategy of taking these firms. So first one is that when once you acquire a firm, or once you take over a hostile takeover take place, so there would be the debt amount would be significantly increased, which actually resulted in downgrading of the debt. The debt was quickly reduced with proceeds from the sale of the asset. However, there was no significant change in the amount of capital investment in these firms. That means that it might be possible that they will increase a significant amount of debt, but the researchers had found that the amount of capital investment hasn't shown significant changes. Then almost 60% of the takeovers were followed by significant divestitures, in which half or more of the firm was divested. The overwhelming majority of the divestitures were units in business areas unrelated to the company's core business. That means that they constitute a reversal of corporate diversification done in the early time period. These things has to be considered before taking over any other kind of business, or indulging into diversification or strategy, because many evidence suggests that those firms which take over unrelated businesses, or different business from its core business, so there would be significant divestitures, which should be an alarming sign. So you have to consider this thing before acquiring the firm. So and also there is significant changes in the management. Almost 17 out of 19 hostile takeovers with the replacement of entire corporate management team in 7 of the takeovers. So thus, contrary to popular view, most hostile takeover not followed by the acquirer stripping the assets of the target firm and leading to ruin it. Instead, target firm refocus on their core business and often improve their operating performance. So this suggests that after taking over the business, it might be possible that entire management team would be replaced, and empirical evidence suggests that in majority of the time this has happened. And there are and secondly, after taking the control of the company, the acquirer does not ruin the assets, or they cannot destroy the asset, but they can target firm, and they can target firm, and they refocus, and they put all their strength in their core business in order to improve it, and in order to improve the operating performance of the company which they have acquired. So that suggests that the value of control is significant. Once the company want to have control, and once the company want to pursue the strategy of acquisition, and pursuing the strategy of increase the value of the firm by change management, or by control. The previous study has stronger evidence that it has worked in the previous period. So you can pursue your strategy regarding this aspect. As we are determining the motive for our acquisition, the another aspect is that we have to find out that whether the motive behind your acquisition is managerial self-interest. As when we talk about acquisition in this aspect, because we are mostly talking about corporate setup in which your management and your shareholders are at two different continuums, and managers are working for the benefit of their shareholders. But in this case, when the managers are putting aside the benefit of your shareholders, but they want to pursue their own self manifested objectives, so in this case we have to find out whether this perception is involved in that, and the company is, or the management of the company is pursuing their own objectives, So there are major three objectives, or you can say broadly speaking, there are three prominent objectives which can be pursued by management in order to entertain or in order to fulfill their self-interest. First one is empire building. That means that a manager want power, and being a manager or being a CEO of a very large company, they want to have more power, and they want to dominate the market. In this case, they want to acquire more firms. One thing might be that they want to acquire those firms which are threatening them, or they are posing more potential competition to them, or they can acquire those firms which are underperform and are not working good, but they can acquire them and amalgamate them in their business in order to improve their power, or increase their power to dominate the market. So first might be that they want to build an empire. Second objective might be to fulfill managerial ego, as when you are acquiring firm and you are into the market, and you are you are giving bidding for the for an acquisition. So there are many people who are providing bids for that specific company in order to acquire them. So in certain time, manager are very much ambitious, and they don't want to lose the battle for bad battle, and they want to acquire, and they want to win that bid for in order to satisfy their ego. So in this case, they can buy the firm in higher prices, and it might cost many $1 million to their shareholders. But their if their ego is involved in that, so they'll do everything in order to acquire that firms. So that is something which can be destroying for the long term wealth maximization objective of the company. But in this case, obviously managerial ego is involved, so they'll go and pursue that their this motive. Or in certain times, the management thinks, or the managers think that when merger and acquisitions are being performed or being done, so in this case, the new compensation contracts or new compensation plans are being introduced. So this can be helpful for the managers, and they can gain more advantage from them. So if the potential private gain to the managers from the transaction are large, so obviously they'll or you can say overlook the benefit of their shareholders, and they go and pursue those deals which will help them to increase to give them benefit regarding their compensation and benefits. So if this kind of objectives or motives are involved in that, so obviously management go and pursue those firms which can fulfill these benefits of these can say motives of their of their management. Now, the second step is, once you have decided the motive, the second step is that you want to select a target firm. If you are clear about your motive, so based upon that, you will try to find out those firms which can pursue that motive. First of all, if your motive is undervaluation, and as we have discussed earlier, that undervaluation means that the motive of the company, or the motive of you is your acquisition is that you want to acquire those firms which are not currently trading at their fair value, and you want to acquire them and to put your managerial and other expertise onto that firm, and to gain premium from that purchase or that acquisition. So in that case, you will go and find out that firms which are trading below their true prices, or if their cash flows are not according to the cash flows of average cash flows of the market, or if their discount if their profits, or if their and many other aspects of their profits are below their industry averages. So obviously you'll go and select that firm and pursue this motive. Secondly, if the motive of your acquisition is diversification. And what is diversification? Diversification motive actually is that when the company wants to diversify or decrease their risk by acquiring different line of business and in business, and amalgamate that in your business. So in order to pursue your objective, this objective, the firm go and find out those businesses which are not related or almost correlated with your current line of business, and acquire them. Or if your objective is operating synergy means that you want to enhance your operation by acquiring that firms. And how you can achieve your operational synergy? We can say, if you want to pursue your cost saving objectives, so in that case you will go and acquire those firms which are currently working in your current line of business, and pursued your objective by acquiring that firm and amalgamate that operations into your business, and decrease per unit cost by producing more more of that or more of your products. So, or you can say that you can increase your growth by extending your operations into new line of new markets, or expand your operations with the help of acquiring the firms which are currently working in your current line of business. So obviously you'll go for those firms which can help you in pursuing these objectives. Or if your objective is your financial synergy, that means that you want to increase your financial capabilities, or you want to increase the financial aspects of your business. So for example, one objective might be tax saving. And how this can be done? Like when want to have have a business which can help you to your this tax saving, that when you acquire those firms which are not very good in their operations, and they have their profitability, or their mostly profitable ratios are not according to the according to yours, or and you are actually gaining more benefits and your profits are high. So in that case, when you acquire that business, so these your profits are offset by the losses of that firms, and decrease the overall tax burden of your company. Or if you are when you acquire the other company, so in that case you will also acquire different fixed assets, or and this fixed assets also have their depreciation cost. So obviously, as we know that depreciation cost decrease the tax burden, so obviously that can help you pursue that. Or if you want to if you acquire the other business, so that can be result in re-evaluation of your equity and re-evaluation of your different assets, so it can also decrease the tax burden of your company. Or in certain case, when you are not in a position to acquire a debt from the market, so acquiring new businesses can help you borrow more money more money and from the market, from the financial market, or from the capital market. Or if you have certain projects are there, and certain projects are there, and the company don't have funds in that, so obviously in that case these cash lags can be used in order to finance those projects which can be beneficial for the future. The next motive might be your control. That means that you want to increase the performance of the business by applying your efficient, or your better performance managerial skills. So in that case, you will find those businesses which are not currently performing very well, and the bad performance is due to the management bad practices. So in this case, you have to be very confirm about that, because if there is if we as we we have already discussed in the previous slides that if the bad performance is not attributed to the bad managerial skill, that you cannot pursue your controlling objective. You have to find out those businesses which are not currently performing very well, and applying your controlling and your better managerial skill in order to increase the performance of that company. So last of my motive would be your manager's interest. So in that case, if the manager interest is involved, or manager's egos are involved, or their power needs are involved in that, so obviously the managers try to find out those businesses in which they can pursue their motive of increasing their power over the market, or you can say that they can find out those businesses which companies by which they can increase their compensation benefits and other objectives. So obviously, depending upon your motive, you'll go and find out those target firm which can pursue your objectives.